Hello, very good morning to all. Welcome to today's Daily Dose of Market Insights by OANDA. I'm Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. So very good morning. Today will be Thursday, the 11th of January 2024. So before we start our Daily Dose, let's take a look at the disclaimers slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. This presentation, losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so now let's have, before we jump into that short-term technical outlook on the various broad-based cross asset classes, ranging from the benchmark stock indices, the major FX pairs, gold, as well as West Texas crude oil, let's have a recap of yesterday's cross-asset performance and as well as key events that I want to highlight earlier on that was released yesterday. Firstly, cross-asset performance. So what we have over here was within our expectation, the market actually continue its risk-on behavior. Why? Because if you look at the major benchmark US indices, 4 of them actually all closed in the green, led by the mega cap technology growth stocks, where the Nasdaq actually outperformed slightly against the Dow Jones and against the S&P 500. So the Dow Jones, the S&P 500, and the Nasdaq 100 all have a daily close of ranging from 0.6% to 0.5%. The Russell 2000 managed to close in the green as well, but actually with a smaller gain or underperformed the other three with a minor gain of 0.11%. And also one of the intermarket analysis that actually supporting this ongoing risk on behavior is due to the easing liquidity condition in the market. So how do we gauge easy liquidity condition? One of the key metrics or indicator we look at will be the movement of the US 10-year Treasury yield. Why US 10-year Treasury yield? Because that is considered as a global benchmark for cost of funding. So if you look at the 10-year Treasury yield over here, is still being well kept below the 4.06% intermediate resistance, or I would say medium-term resistance, 4.06%, refusing to actually pierce up above it in the last 4 sessions. So that is actually confluence with the 200-day moving average as well. And with that easing liquidity condition we see yesterday, we start to see a lackluster dollar strength movement with several major FX pairs continuing their dollar weakness, especially with the sterling. All right, that means dollar is rather underperforming against the sterling right now. So even though what we could, let me share with you the movement of the FX market. So this is a 5-day rolling performance. That means it's like a moving average, but it rolls every 5 days short term as of now. So we could see over here for sure the sterling, so everything is plotted against the dollar. That means dollar as a base currency. What is a base currency? It means $1 equals to how many sterling, $1 equals to how many Aussie, $1 equals to how many Kiwi, $1 equals to how many yen. So it's easier to monitor. So you look at over here is that the dollar is the worst performer so far against the sterling. And if you look at the bunch of it over here from the CAD, seeing CNH, Swiss, Aussie, Kiwi, all of them are actually looking for what I call potential ongoing dollar weakness against these major popular traded pairs currency. Even there was a slight uptick in the dollar yen yesterday, but its strength seems to be starts to dissipate as well. And overall, the shorter term 2-year Treasury, US 2-year Treasury spread versus the rest of the world, taking into account of this key major economy, that means the average of 2-year US Treasury yield minus the 2-year sovereign bond yield of this average, German, UK, Japan, Canada, Swiss, AU plus China. Why China? Because China is an important economy to monitor right now. And we could see over here is that the US 2-year yield premium has started to shrink in the last 5 days. So if you look at a bigger picture from a medium-term perspective, by a 1-month rolling performance is also similar as well. It's much more clearer of the US 2-year premium shrinkage against the rest of the world, and we start to see the dollar strength also slowly continue its downward trend. All right, the dollar weakness, that means dollar weakness. All right, so now we see a bit of almost unchanged movement yesterday for spot gold XAU/USD, and as well as the West Texas crude oil sideways movement. So West Texas crude oil is still trapped between two key levels between support and resistance. So later I'll share with you. And for WTI crude oil price right now, in order to see much more positive resurgence on the bullish story, it got to surpass the 50-day moving average that is still acting as a resistance around the $75 per barrel. So later I'll touch on more about that short-term technical outlook for WTI crude oil. So that's actually sum up this we call overview of what happened yesterday in terms of cross asset performance. So now let's look at the key economic event that took shape that I want to highlight to you all. Is very clearly there is signs that in Japan there's a lot of faction or a lot of what I call key important people or stakeholder is pushing to end that negative short-term interest rate. And bear in mind, Japan is only the nation, or in fact within the emerging market and developed nation, that still has short-term negative interest rate. All right, so there's a influential ex-BOJ official board member, Makoto Sakurai. He mentioned in yesterday interview that BOJ is fully prepared to end negative rate and likely in April. So why likely in April? Because this is where the Japanese year, the Japan financial year starts a new financial year. So they goes a bit different. So their financial year starts from 1st April all the way to 31st March. Okay, so and also from now until the start of the next financial year, most of the Japanese unions are actually negotiating on behalf of their employees with the employers in terms of wages adjustment on the upside. So wages growth, a substantial wages growth is very important. One of the key metrics for the current BOJ leadership, especially BOJ Governor Yuda, to actually monitor whether there could be a substantial push up in wage, we call it growth, eventually will actually lead to a demand side inflation increase. Because in the last 1.5 years or so, in terms of BOJ Governor Yuada eyes and in his mind, the push up in Japanese inflation is more cost push driven. That means we talk about oil prices or this, and he need to see much more substantial on the demand side to actually allow the current rate of inflationary growth in Japan to remain elevated above their target of 2%. And one of the metrics they look at will be wages growth. So that's why most market watchers, in terms of prominent figure or some of the business, we call it the business association, they're actually pushing for BOJ to end short-term negative interest rate, because they do have a strong view that wages growth is on a path of upward trajectory. Okay, so something that we actually got to be closely monitored as well. Why? Because that could actually impact the dollar yen rate, and also most importantly, the strength of the current bullish tone of the Nikkei 225. So as long as we start to see there is a clear signs that BOJ is signaling to the market that Japan has more or less defeated 20-year plus of deflationary move, it could actually potentially lead to this ongoing bullish tone that is seen in the Nikkei 225 that is so far outperforming the major benchmark US indices year to date, given though that we are only start of the year for 2 weeks from now. And it could actually lead to potentially repatriation of a Japanese firm capital outflow back into Japan. And as well as there's also I talk a bit about this, there's also this push by the current Japanese administration to actually do a bit of asset transformation from savers to actually allow to educate the Japanese citizens or the member of the public to start investing in the local market, given the fact that deflationary pressure has started to significantly ease off in the last 2 years in Japan. Okay, so that's about the Japan story. Now, with that, let us continue with our normal daily dose, which is our share view, the short-term technical outlook right now. Okay, so let us start with the benchmark stock indices first. Okay, Asia Pacific, Hong Kong 33. So Hong Kong 33 for sure the 16,100 level is the key level to watch. Why 16,100 key level? Because that is a long-term circular ascending trend line support level on the Hang Seng Index since the great financial crisis low, the Asia financial crisis low, probably since 1998, which I highlighted many times in my daily dose of market insight. So I will highlight again for you all to see why this level is important, 16,100, for those guys who miss my daily dose of market insight in the last couple of days. All right, so let me highlight for you all and let me expand my screen so that you all guys can see much more clearer. Okay, so this is a long-term monthly chart of the Hang Seng Index. So what we could see that 16,100 over here, why is it important? Is this long-term circular ascending trend line all the way from the Asia financial crisis low of August 1998 that has been supporting the market in any severe downturn from 1st April 2013, 2003, October 2008, that is the great financial crisis inflicted by the US subprime bubble bursting, and as well most recently during the clampdown of the private sector in China, permanently hitting on the China big tech stocks, pardon me, and as well as the stringent COVID-19 lockdown, managed to survive, and right now it's trying to retest that 16,100 level again. So using this 16,100 level, a lot of people will say, can it be substantially lead to a higher rebound since this touching this level? To me, honestly, I have no yes answer or no answer right now. I'm taking things one step at a time. For sure, in the terms of a technical analysis perspective, to see a much more substantial rebound as in multi-month potential recovery, it got to break above this key major trend line that is in place since January 2021. So that is right after the the start of the COVID-19 lockdown, and also the start of the clampdown on the China private sector. It got to break above this level here, 18,460, before we can see any potential substantial multi-month kind of recovery. So for now, any rebound on the Hang Seng Index is more like a minor corrective rebound lasting for about maybe at most multi-week. All right. So now back to the technical chart of Hang Seng. So for sure, we know that this is a key level, 16,100. So we'll be using 16,100 level as my short-term pivotal support for today, still maintaining that short-term. So I want to stress is short-term bullish bias. That means talk about multi-day minor corrective rebound, at least in first step, to test 16,500, which is a near-term resistance over here. While this 16,500 is actually confluencing with the minor congestion former swing low area of 5th of January and 3rd of January last week, and also the 20-day moving average that's still acting as a near-term resistance. Only a clear break above 16,500 potentially sees the next intermediate resistance coming in at 16,950/17,160, also confluencing the downward sloping 50-day moving average. However, hourly close below 16,100, then potentially we could see a kind of a spike down towards the next support level at 15,500, i.e. still maintaining that short-term bullish outlook for potential minor corrective rebound on the Hong Kong 33 index as long as it managed to hold at the 16,100 pivotal support. Okay, Nikkei 225, Japan 225, we highlighted yesterday. Price action continue to be its bullish momentum. RSI, yes, we know it's extreme overbought, but there's no signs of a bearish divergence. That means we don't see the RSI sloping downwards like this. It's still maintaining a similar level of high. So indicating to us that, yes, we know that it's extreme overbought, but there is no sign of a significant pullback that may take shape at this juncture. So with that, right, I'll be potentially, yeah, you could see a bit of bounce over here. So this is yesterday's level, yesterday's US session level. Okay, yesterday US session level before it start bursting up in today's Asia session. So I'll be using this level as a kind of a near-term support level for pullback around 34,800. But slightly below it will be my short-term pivotal support, 34,500 level. So as long as 34,500 level didn't surpass on the downside, potentially this impulsive up leg should potentially continue. So still maintaining that short-term bullish outlook on the Japan 225, which is the Nikkei 225, towards the next intermediate resistance zone at 35,500/35,700 level. Only a clear hourly close below 34,500 then could actually lead to that what I call much more substantial minor corrective pullback to retest the former range medium-term range resistance turns into a pullback support at 33,960/33,825. So still maintaining that short-term bullish outlook with a tightened key short-term pivotal support at 34,500 on the Japan 225. All right. German 30. So German 30 was yesterday pretty much sideways, but it actually reacted positively right at the short-term pivotal support that we highlighted earlier on, 16,610. So for sure, this will be a near-term support level to watch for today, okay, which is yesterday's level, yesterday's low, yesterday's yesterday US session lower, which is 16,680. So I don't want to use 16,680 so tight as my Titan key short-term pivotal support for today, because it hasn't surpassed the near-term resistance at 16,790. So this is a very clear level that preventing the boost from surpassing since the start of this year, 2nd Jan. So unless it clears above 16,790, then I could use 16,680 as my short-term pivotal support for today. But so still using the 16,610 level. So 16,610 level, short-term pivotal support for the German 30 index, still maintaining that short-term bullish outlook or bias on the German 30. Clearance above 16,790 exposes the next intermediate resistance, which is the range resistance that is in place since 14th of December at 16,970. Only an hourly close below 16,610 invalidates the bullish view to see it tumbling down towards a corrective pullback, I would say, to retest the low of this year low, which is last Friday low, i.e. 16,440. Dow Jones Industrial Average. So for Dow Jones Industrial Average, it continued to bounce up above the 20-day moving average as well. So near-term support will be at 37,500 level, but it hasn't surpassed the all-time high area at 37,800. Momentum still remains strong. No, it's overbought, but not really at the extreme overbought level yet. And also there is no clear signs of any bearish divergence signal that's being flashed out on the hourly RSI. So indicating to us that short-term momentum still remains strong. But I don't want to be so tight at 37,500. Still using yesterday's 37,380 short-term pivotal support level to maintain this short-term bullish outlook or bias. Above 37,800 sees the next intermediate resistance, 38,100 level. However, hourly close below 37,380 will negate this bullish tone to potentially kickstart another minor corrective decline towards the next support at 36,170. Nasdaq 100. So Nasdaq 100 going to shape higher high over here. So what we could see over here is that I'll be using the yesterday's US session low. RSI remains positive, shaping higher low ever since the bullish divergence that was flashed out earlier last Friday. All right, so with that, I'll be using a slight tighten key short-term pivotal support level for today, which is corresponding to yesterday's swing low and the former swing high area of last Tuesday, turning to a minor congestion area, very clear area over here, 16,660. Tighten short-term pivotal support level for the Nasdaq 100, still maintaining that bullish outlook towards the all-time high area at 16,990. Above it sees another level, which is defined by a Fibo extension cluster level, 17,080/17,120. Okay, then only an hourly close below 16,660 will negate this bullish tone to see another leg of minor corrective decline to retest the next intermediate support zone at 16,500/16,430 level. Okay, so this level is actually close to the 61.8 Fibo retracement of this current push up from the low of last Friday. Okay, 61.8, 50%. Okay, so all in all, we are still maintaining that short-term bullish outlook across the board for the major stock, for the major benchmark stock indices. All right. So now, what's next will be the FX pair. So let's start with the euro dollar first. So for euro dollar over here, what we could see, price action continue to inch slightly high, continue to actually churn higher above the 108.90 level. So it's still trading within this range, this minor range of 108.90 and 110 figure level. So still no change, because it's still trapped inside the range. I do not want to put it so tight for today. Okay, this is close to yesterday's US session low. Okay, sorry, in fact US session low was here. All right, this US session low. So I don't want to put it so tight to yesterday US session low, which is at 1090. Okay, because it may get whipsaw. So still using 1.0890 short-term pivotal support level, maintain that bullish outlook, short-term bullish outlook on the euro dollar. It got to clear above 110 level to give it a bit more of an impetus to seek to potentially expose the next intermediate resistance at 110.60, followed by the swing high area of late last year, 28 December at 111.30. Only an hourly close below 1.0890 will negate this bullish tone to see another round of corrective pullback or decline to test the 50-day moving average and as well as the 20-day moving average and the medium-term ascending channel from 4th October 2023 low, which is acting as a support at around 1.085, 1.0820 level. All right, sterling dollar. So sterling dollar, like I mentioned, is the one that is the strongest against. That means the dollar is weakest against the sterling, i.e., because okay for sterling dollar, it's going to actually trade higher, shaping higher low above the upward sloping 20-day moving average and also above this medium-term ascending channel after a test on it yesterday, which is at around this 1.2680 level. So given its very strong reaction of these two elements that are confluencing at a similar support level at 1.2680, so I'll be using 1.2680 as my Titan key short-term pivotal support level for today. And now price action is now clearly trying to break above 126.60. So the next resistance level to watch will be last year's swing high area of 28th of December at 12820. A clearance above 12820 potentially sees the next intermediate resistance coming in at 12940. Only an hourly close below the 12680 level will negate this bullish tone to see another round of choppy minor corrective decline back to the bottom of the minor range support level at around 126 figure, 126.20 level, which is all confluencing with the upward sloping 50-day moving average that is coming to actually act as a support at around the 126 figure level as well. Okay, so still maintaining that short-term bullish outlook on the sterling dollar with a Titan key short-term pivotal support for today at 26.80. Aussie dollar, okay, so for sure, Aussie dollar also going to bounce above our short-term pivotal support level at 66.70 level. So still trading within this sideways range. Over here, you could see it got to, so first resistance to watch will be 67.50 slash 67.70. Only a clearance above 67.70 demands will give it a bit more of an impetus to actually see next intermediate resistance coming in at 68.35. All right, so still maintaining that bullish bias holding above 66.70 unless we see an hourly close below 66.70 on the Aussie dollar will negate this bullish tone to see another round of minor corrective decline to test that 200-day moving average, the 50-day moving average, as well as this medium-term ascending trendline support that is in place since late October 2023, or acting as a similar or confluencing at a similar graphical resistance zone, support zone at 66 figures slash 65.70. Dollar yen. So dollar yen yesterday see a bit of spike up above our Titan key short-term pivotal resistance at 144.90. But what you could see right now is it seems to be failing to break above the previous high that was seen on late last Friday at 146 figure level. And also, if you look at the RSI over here, the RSI hit the overbought level, and after hitting overbought level, it actually broken down below a corresponding trendline support level. All right, draw over here. Okay, so indicating to us that yesterday's upside momentum, minor upside momentum from the low of Tuesday, it seems to be dying off. All right now, based on the movement of the RSI, that means we're talking about upside momentum winding off. Okay, so with that, I'll be using 146 figure level, short-term pivotal support level, resistance level, still maintaining that bearish outlook, short-term bearish outlook on the dollar yen. First support level to watch 144.85, followed by 143.45. Okay, in short term, these are the two short-term levels. But 143.45 is pretty crucial. Swing low of 9 of January and confluencing with the 20-day and the 200-day moving average, so acting at a similar support level at this level as well. However, hourly close above it will see a bit of extension of this minor corrective rebound towards the 50-day moving average at 146.70 slash 147.40, which is this graphical range resistance over here that took shape early December last year. So still maintaining that short-term bearish outlook on the dollar yen. So net all in all, we are still looking for potential technical weakness on dollar strength coming back into the picture. That means dollar technical weakness. Spot gold. Okay, so spot gold, like I mentioned, sideways, no change. So still hovering above the 2015, 2000 short-term pivotal support, but can't break above the near-term resistance at 2038, which is also confluencing with the 20-day moving average. So with that, we're still maintaining that bullish outlook on spot gold since it's managed to held above the 50-day moving average and also confluencing with that 2000 short-term pivotal support level. Clearance above 2038 potentially exposes the next intermediate resistance at 2060 in the first step. Only an hourly close below 2000 level will see an extension of this minor corrective decline that is in place since late December last year to expose the next support level at 1990/1975, which is slightly above the 200-day key moving average. WTI crude oil. So for crude oil price, going to chop around the two important resistance support level, 69.70 short-term pivotal support level, and the near-term resistance zone of 74.95/76.05, which correspond with the downward sloping moving average, and as well as the swing high area of 27th December. So still no change, still maintaining that bullish bias within these two range. Over here, 69.70 will be the short-term pivotal support. Resistance zone to watch near term will be 74.95/67.05. Only an hourly close below 69.70 will actually kickstart another round of chop. We call it potential minor decline to test the medium term support zone of 67.55/67 figure on West Texas oil. All right, so that's sum up for the short term technical outlook for today. And before we go, there's one important data to watch out for today that could drive the volatility of the different cross asset classes performance will be the all important US CPI data release. So today there will be the US CPI data release at 9:30 p.m. Singapore time. So market will be paying very close attention to the core inflation rate. So that's actually excluding uh, food and energy. So market is expecting another dip down to 3.8% year on year from 4% printed in November. So if you look at the trend of the core inflation rate over here, it's actually slowly inching downwards. So given that is if we're coming at 3.8% with market expectation, that could be close to a 2-year low of core inflation in US. So you look at the trend, it's been inching down. So that actually would actually kind of supports this Fed dovish pivot coming into play. But one particular key metrics within the CPI basket is they will strip out housing as well. So that is actually the services inflation that market participants is closely monitoring, and the Federal Reserve officials is monitoring this as well, because this one still remains pretty much sticky or elevated on the upside. So if you look at the services inflation last year, this year on year, so last year November, it managed to slightly tick up from a 2-year low of 5.05%, it tick up to 5.17%. So if you look at the trend over here, it seems to be there's a little bit of reversal or minor reversal. So if today's level starts to tick up higher again at 5 point, let's say 20, 5.18 or 5.30 level, that could actually hold on to the Fed dovish pivot. That means the Federal Official Reserve may starts to be a bit much more less likely to open up the liquidity water taps as soon as March this year. So this is one of the key metrics that we should be monitoring as well, services inflation in the US. So with that, if this number start to tick up higher, that could actually see a bit of pullback in terms of the major US stock indices as global stock indices current risk on behavior, and we may start to see a uptick of dollar strength, minor uptick of dollar strength coming back into the picture if the services inflation tick up higher this last month, which is the month of December. So with that, yeah, we come to the 30-minute mark. So I'll end today's daily dose of market insights. So thank you for your time, and we shall speak again tomorrow. Have a great day ahead.